I'll let we can kind of let everybody who has questions and do some stuff and maybe come up with an agenda for our next meeting. And answer any questions we have, since this is going to be a little more intimate.
All right. So are you calling this to order or am I?
Yeah, we're to order. I was told we don't necessarily have to follow that, so consider us to order.
Awesome. I have been thinking around this, and Maria, you've seen a version of this, and James, you've seen a piece of this, and it's and so has Gwen. Hans, you're the only man out at the moment, and Meg apparently. Sorry about that. I tried, but and Gwen actually has a question that I think is imperative that we answer either before or after this. But maybe I'll just present this, and then we can take the questions and field her question at that time, if that's all right with everybody. So bear with me. And you should all know that I use a spreadsheet like a whiteboard, which is a terrible thing to do, but it just is. So I'm weird about notes and boxes and things. So bear with me as we go. And one last piece. So as some of you know, I've been wrestling with this since last summer, and just trying to come up with a way of first it was the Affordable Housing Task Force, and now it's this, of trying to come up with some way that could do what we are saying this is supposed to be doing, which is to allow seniors to age in place, to take care of our financially vulnerable, and to also help CSD not lose more than what they want to lose. And the number of 500,000 is not a quote magical number, but it is the number that I have used in this case to do the calculations. And before I do this, slide it out of the way for a sec. I want to make note of just a few things, which is the numbers that I'm going to be talking about are, for the most part, second billing 2019 tax digest that's official from the city, or from the company that does the billing for the city. If we look here, and if the numbers aren't big enough, please let me know if I need to make it larger. I tried to look at the average and the median home values. These are all properties taking the S4, and this is 17, 18, 19, and 20. And so we look at the average as well as the median, they are well under, or under anyway, the 500K mark. Another question that I wanted to see for myself was, where are these located? And these are the S4s currently that are valued full market value, full appraised value at 500K or less. And as you can see, they're fairly well spread across the city. So there are no hot pockets in here. Go back to the spreadsheet one more time. So then I tried to look at, if we're trying to deal with the financially vulnerable, then we have one way of looking at this, which is the GS1 exemptions. And this is, again, second billing 2019. There were 320 total, and this is, you have to be over 62 and an income of less than or equal to 25K. And it's of any type, which I thought was interesting. But so there are 24 of them that don't qualify yet for the S4. But of the ones who did qualify for the S4, what I'm proposing actually takes care of still includes 93% of those households. So I'm hopeful that that's approximating, getting into that question of the financially vulnerable that we can discern. I was a little puzzled by the 22 that were valued higher. And as I dug into them, I realized how many of them were held by a trust. And as someone said to me, actually, I think it was James, yes, they planned well. They are drawing down a savings account or some other form that doesn't count as federal income. And I can tell you that 2 of those have already sold. So that number really is 20 at this point, but that's neither here nor there. So the question is, how did we get here? And I didn't show you the other map. So if we look at the combination, the intersection of S4 properties valued less than 500K and taking that GS1, we now start to see a concentration in an area where I would be expecting to see that concentration. So the question is, how does this work and why does it work? And I found it interesting that using the 18.65 mil rate, we can make this anything we want, but that's the one that we had used, and it was close to what was in the Tableau tool, I believe. I think the Tableau was actually just 18. If we look at this, this is sort of a net line. This is worst case scenario that says if all the people who have a home value over 500K are also age 70 and older and take the $50,000 exemption, then what is the net loss? And you can see that it went from 1918 and suddenly 1212. If we assume that only half of those people actually are 70 and older, the number obviously improves as far as a net loss. And then the average is just the average of those two that basically says if 75% of the people with home values above 500K are 70 and older. So the numbers still kind of work out here. And so that was a puzzlement to me of, well, how? And the blue are homes, again, all S4 homes currently. And we see it's sort of a flat line in the under 500K category. But in the above 500, we see a pretty good step. And that's these numbers up here. You see we go from 70 to 137. From 70 million to 137 million in just 4 years, which is a pretty fast ramp. But given that we have, this is, you know, again, this is the city's numbers, so I can't argue that they're not right.
Wouldn't that be reflective of tear downs and rebuilds? I mean, that is actually probably what you're seeing in that data right there.
Well, that could be part of this, but remember, these are properties taking the S4 exemption, so they are 65 and older, and I don't know how many tear downs we have that are resulting in a sale to somebody who's 65 and older. I don't know the answer to that. It's a great question. I do not know the answer, and I don't have an easy way of getting to that. I will share with you that in the cities, and some of you may have participated in the city's budget meetings, but for the first time that I've ever seen anyway, the reassessments accounted for only 44% of the increase in the tax digest, with 56% being new value. And we can see the 2018-19 was basically a reverse of that. So I think that is probably definitely in the category of the tear down, rebuild, large home, for sure. And some of that's the apartments. We're finally at an 80-20 commercial to residential. So back to the Word doc. Oh, it's open silly. Okay, so it seems to hit the right folks. We're never going to make everybody happy, and we know that, unfortunately. But the trend, if the trend continues as it is now, we should not see a reversal of these property values. We've never really seen a dip here that I can find anyway. So the next question really is, so how do you manage this? And I am more than open to anybody's questions and ideas on this one, but I was trying to keep this as simple as possible. And so the idea is if it qualifies, we have to pick a slice of time, maybe second billing 2020 when all the assessment challenges have filtered out. Properties that qualify would retain that until the property is sold or the title changes or whatever the legal term is as far as that goes. Or an intentional increase in value occurs. And this is the more tricky one, but this is trying to address, let's say somebody has a $475,000 full value home and they're taking this assessment and then they decide to remodel a kitchen and add on a story. So they are substantially increasing the value of their home. Well, if they have that money to do that, they obviously have the money to pay the taxes. So this also hopefully eliminates the argument of million dollar homes taking the exemption. And in this case, Gwen asked a question earlier of me, and I said, yes, this is cross-subsidizing. It is sort of, in this case, I'm proposing to use the value of the property much like we would an income limit, that above a certain number, then you don't get the exemption. There are other exemptions that might add on, like the S3, which is the calculation that is attempted over here. Here and here. So that's the if all take it, if half take it. Now, Gwen, if I may, I would love for you to ask your question first, because I think your question really digs to the heart of this, of whether we should even spend another 10 minutes on it.
Okay, so my question, and I like Paula's approach. I just want to make sure of kind of our base where we're starting when we determine the $1.2 million revenue loss that we're looking for, or the cost of the exemption. So I'm looking for, in the budget that was presented to the school board this year, you're looking at $42 million in property taxes. Mm-hmm. So if we're looking at a $1.2 million loss from the homestead exemption, is it the thought that the 1.2 million, you don't want to exceed a total of $1.2 million in property tax loss, period, across the board from the homestead exemption? Meaning if you're looking at $42 million, you'd be saying basically $40.8 million is a number that we can live with. And part of the reason I'm asking that is because, and Paula, correct me if I'm misunderstanding this, but when I'm looking at this, I see that it looks like, say, in column L for 2019, you would have a revenue loss for the homestead exemption for properties under $500,000 in the amount of $3.2 million.
Right.
Okay, so that 3.2 million would actually be subtracted from the $42 million in overall property taxes. But it's showing as kind of the net of 1.2 that you're showing is because of adding back in the properties that are now exempt that are worth more than $500,000. Right. So the resulting exemption would be $3.2 million under this scenario, as opposed to $5.5 million, which is what it looks like the exemption would be if you exempt all properties. So we're not, I guess my question is the goal to add enough properties back so that it looks, so that when you combine what you've added in with what you've kept out, you're looking at $1.2 million? Or is the goal to say, this is our property tax number and we only want to lose 1.2 million of that to homestead? And I may not be explaining that very well, so if I'm not articulating it well, let me know, and I'll try again.
Gwen, that makes sense to me. I understand your question, but for me, I saw it as that what we have in is of a level that what we have to take out doesn't hit us as hard. So I do understand your question. It does make sense.
And it may be a question we need to ask Dr. Duty for clarification on, and that none of us on the call right now can answer.
Correct. So the real question is, can we cross-subsidize with the properties that don't meet the exemption characteristics?
Well, I think that legally, I mean, I think that you can do what you're looking at as far as providing an exemption to some properties and not providing an exemption to the others, as long as there's a rational basis for doing that. And I think that there is one. The question to me isn't so much, you know, whether you can tax some properties and not others, as long as you can draw reasonable distinctions, but it's more, does this particular criteria or formula get you to the number that you want, get you to the revenue loss that you want from the property tax exemption? And one thing I mentioned to Paula is, you know, another thing to throw into the formula to consider would be, if you took these same properties and the same dividing line of $500,000, and you said instead of a 100% exemption for the properties valued $500,000 or less, you did a 40% exemption or a 50% exemption, so that the exempt amount was less. And that's just an example. I mean, it's still, if you did 50%, it would only get you to, you know, 1.65 as opposed to 1.2. But there are ways that you can play. I like the defined parameters and the, you know, using the, what is it, the GS1, whatever the existing one is with the income limitation. I like the combination of the income limitation and the assessed value. I think it's creative, but it's also measurable. We just might not be able to do a full homestead exemption using those particular parameters. And I would be very interested in Dr. Judy's thoughts on what that 1.2 million goal is.
So Paula, the red, so column L7 is for houses that are greater than, less than 500K.
Less than 500, right?
There are 989 homes
Correct.
in 2019.
Correct.
And they brought in, is that the total, or is that total for the, that is what would be exempted?
That is what would be exempted, yes. And it's in, it's red obviously because that's the
gotcha.
beginning of the loss.
Okay.
And then line 8 is those properties not being exempted. What is the revenue that comes in? Okay, and then we get a subnet here, and then again on over here I said, okay, if all of those, trying to do worst case scenario, if all of those are 70 and older and they take the $50,000 exemption, what's the additional cost for that? And adding this number and this number to arrive at worst case scenario, essentially, right? And then looking again, if half of those, and I can tell you based on the prior years when we were actually tracking who's 65 and who's 70, when we were really tracking all these, and because we stopped tracking them once the S4 went into play. But looking on the trend lines that we shared weeks and weeks ago, I would think that it'd be probably along the half mark would be more accurate based on past trends. But again, that's past. We can't really know for sure. And since we can't get data broken down from Georgia State based on age or household income, then so this calculation is likelihood of the total loss. And then I took the average because it might be as high as that. It would be, it's not possible that it's high as, it's not possible to be this high. That just, because we know that all the people are, I mean, that would be a statistical nightmare of, or a big surprise anyway, that every person who owns one of these 400 homes valued above 500K currently taking the S4 are also all 70 years old or older. That would be pretty out there. So Gwen's question is a great one. Does this number need to be 1.2? Does line 7 need to be 1.2? Or are we talking about either 13, 17, or 19? So is cross-subsidizing allowed in this calculation or not?
My understanding is that the request from you all is to come up with a proposal that starts in 2021 to estimate a total loss in revenue versus the tax base of 1.2 million of what is anticipated around 40 to 43 million coming in, as opposed to the what it was 5 million, 5.6 currently.
Okay.
And just so we're clear, that 5.6 is net of all the exemptions, not just.
I think that's just S4 currently.
So just S4. So effectively, we need to change S4 to give back $3.5 million, 3.8 million.
Don't quote me on the S4 number, but I believe that that's right. Yes.
So then, I mean, if the objective is to change S4 so that in effect we give back 3.8 million of it, I mean, let's assume that it is a $5 million bogey, which is what it is right now. Then I don't think this isn't capturing that.
It seems like L13 is capturing that. Is that right?
It's only capturing it because it's capturing it because you're starting as if this is where you are, like from your current exemption, your current 100% exemption. And so you're going to add back 2.3 million that you currently exempt. And so that helps if you take that 2.3 million as an offset against the 3.2 million that you're going to leave out.
Mm-hmm.
Then in that way, the numbers get there. But if you're just looking at, we only want a $1.2 million revenue loss or revenue hit from the homestead exemption, then you have to look at it differently.
Yep.
Got it. Okay.
In effect, that $2.3 million number needs to be another $1.5 million higher. We have to give back 3.8 million. And in this case, we're giving back 2.4.
So I guess this is a beautiful moment for clarification of which way are we really trying to push this.
Yeah.
The other thing that not to throw a giant wrench into the works on this, but I do want to ask a couple questions about the direction Decatur is going in with its housing, right? As things like cottage courts and more affordable, smaller footprint houses come in, I think the presumption around some of that density is that you will have a fair bit of homes that are below 500K. Now that's obviously, that's not built yet, right? So it's probably not something that we need to blow up. But if it is the stated direction that the city is going to try to develop some of that density, this is something that's going to serve us for the next 2 or 3 years, but in 5 years start to drift heavily. Like, we just should be cognizant of what the ramifications are as density is built out.
And then who the density is kind of geared towards, because do we think it's going to be younger, or are we going to do, and I don't know, Paula, if you remember anything from Affordable Housing Task Force where there were any discussions around specifically targeting an older population where they would sooner fall into a point where, hey, I get that tax break.
Well,
So,
and I think that gets to, I'm sorry, Paula. Go ahead.
Go ahead, Hans.
Well, I was going to say that I know we started this with allowing us to support aging in place, and we ended up more in an equity conversation, but I think we should still have in the back of our heads the concept of aging in place. We probably shouldn't be developing tools that start taking some of those that relief off the table.
So the cottage court, good example, it's my understanding anyway, sort of hit a snag with cost and never got a full set of wind under its wings. And it was not being marketed to seniors. It was being marketed to younger people. That was the intention. As I understood it, the biggest parameter was people who are working in the city of Decatur and want to live in Decatur. Mm-hmm. The vast majority of senior housing that we have put up around us are apartments. Some are subsidized, some are not. In some ways, this using a 500K value actually helps a little bit in promoting density as opposed to single family dwellings, because we know that SFDs are much more expensive than in full appraised value than condominiums even. And we actually have a couple of condos here that have sold that I know people are taking the S4 currently, and I've had conversation with them about, are you going to be running for my head when you don't get it anymore, if that should be the case? And they're like, no, of course not. I mean, we understand the dynamics, but we don't have that many, even here at the Artisan, and that we don't have that many at 335 Ponce, which are the two buildings where I would be expecting to see older people, because we have a substantially, we skew toward older population here. And I don't know about the 335 building because I don't know enough about it. But your point's well taken, Hans. I tried to look at this from definitely a long-term perspective. And if the numbers here of the value of homes above 500K, even if it just plateaued, assuming we can do this cross subsidy piece, if not, and the ultimate goal is for this particular number to be no more than 1.2 million, then that's a completely different discussion.
Well, I think that the net of those two numbers needs to be the 1.2, right? Like that's where, and so not to put you on the spot with your modeling, but if 500K isn't the number, what is that? are we able to adjust the housing number to find out where that does actually net out?
Well, and I love you for asking that question. If my Excel skills were better than they are these days, the answer would be yes. And I considered putting it into Click, which is the BI tool I use, but trying to keep this as clean as possible. I did test other ranges. I tried 450, I tried 600, I tried all kinds of things in between. And it was when it was this 500 mark that actually got us to worst case scenario, roughly 1.2 million. And I will make the argument that we can't just pick a static number, that if we're looking at inflation, we're really talking about 1.25.
No, clearly, like, I mean, if we're going to be held rock solid on 1.2, then what we're going to be doing is creating a homestead exemption for houses that are $457,942.38. Like obviously we're going to get as close as we can.
Right.
But if my understanding of the math is correct, the number in red needs to be the 1.2, and the number in black needs to be the 3.8. And so there is a housing number that will get us that. Now, so let me be clear that I guess there's two interpretations. This is sort of the best case interpretation, where we're talking about an incremental change, but then the worst case is where it really truly does need to be a net 1.2, in which case basically the black number needs to be 3.8 and the red number needs to be 1.2. And there is a, no, I'm sorry. Yes, I'm sorry, that is actually right. And so there's a housing value somewhere south of $500,000 where that cross happens.
Yes, right. I'm sure there is. I feel good about that.
Can I just say for the record that I was a little weirded out that the data set couldn't provide an N analysis? I mean, there's really two ways to interpret that, I think. I mean, one is if they do provide us the N, a particularly sophisticated data user could probably recreate their database. And so I sort of understand that they don't want to provide that number because it allows a backdoor recalculation of what they've done. But the other one that's slightly more problematic is that their numbers aren't actually aggregated numbers. Instead, they're modeled numbers, in which case there's a much larger confidence interval issue with the actual data that's coming out of it. And so that's just something for the school system to be thinking about. You probably should find out which of those two scenarios it is. And if it's modeled numbers, then when we set it to 1.2, it's going to be plus or minus, 25 or 30% of that. And you're just going to have to live with that sort of a error band. Does that make sense? I don't know if I explained that well.
It makes perfect sense. That's part of why I've tried to put the argument out of using actual data as opposed to a modeled data, because we have the data.
Yep.
So if we have real numbers, I don't know why we wouldn't use them.
Totally agree. Totally agree.
I also find it interesting that I've tried working with the Tableau tool and trying to trying to make it make sense, but even the income requirement increments don't allow me to even approximate the GS1, which is 25K. So the jump from 10 to 40, I can't fine tune this to figure out which are we protecting? Because to me, the concept of being able, again, to protect 93% of those GS1s, current GS1s, to me was a big win of, okay, we are trying to protect the most vulnerable financially, and these people have already demonstrated they are among those people. So, but it still remains, to me, the big question is, does this number for 2019 need to be does that number need to be 1.2 million on every one of these boxes? It's not just this one, but on any of them, right?
Going forward, yes.
Right. And I'm not exactly sure how you would, because we can't change, I don't think anyway. I don't think you can have a floating number of the cap, right? So it can't be like 500 one year and then 472 one year and so on. I mean, I don't think you can do a float.
Let me ask a couple things about, so the fluctuation in the number of houses that meet that criteria is interesting, right? Is 986, 1033,
right?
989, 1008.
Right.
Are there that many properties being, so like I understand why 1 year it would go from 1033 to 989, right? Obviously your homes are appreciating, but for it to jump back up, that means that between 2017 and 2020, far more than the 32 whatever houses were built in that time frame to that value, right? Because a significant number of the ones that were built then appreciated out.
Right.
Is that the right way to think about those numbers? I mean, I guess that this is a more complicated way of looking at the exact problem that you're mentioning, which is none of this stuff is static. This is going to be highly fluid over time.
Right. So I do know that some of the numbers that moved from here and this number going down, at least a good portion of those were sales and then tear downs and rebuilds. So I can understand the loss number. Yep. The increase back up. I don't know I don't know where that was coming from. I don't know if those are condo sales with older people moving in and qualifying, because again, if it's dense housing, chances are good it will be less than $500,000 full value.
So, I mean, I hear that. Let me challenge it, because all of that stuff that was built out on Hampshire and in the old Decatur district area, that's all $650,000 condos, right? So, I mean, there's a lot of stuff that's being built higher.
So the townhomes tend to be, yes. I mean, and someday they're going to get those right on Northern that sold for just under $1 million. But I would not want to be that person. You've got to think about existing stock. And think about, I mean, I could easily pull the numbers for you to figure out how many units here at the Artisan are valued less than 500K, full appraised value. And so if we have a 65 or older person move in, which we frequently do, people move here, want to live at the Artisan, they want to move to be close to their kids and grandkids. And we have family after family.
Yeah, I'm sorry. I'm thinking new built, but no. That's correct, right? This could be reflective of people like an under $500,000 home selling from somebody under 65 to someone that is 60. Yeah. I got it. So yeah. I totally see.
So let me ask you a question about caps. So to your point, Hans, we have to look at fluctuation here. And so as we go across, if someone lives in a home that's less than 500,000, say it's like 492, right? And then the next year, its appraised value is over 500K. Mm-hmm. Do we then say, oh, you no longer qualify? Or do we go with their original, when they originally signed up for it? Or how do we?
And that was actually the last thing I tried to address here.
Okay.
That was the stuff about the remodel. Like,
right.
Yeah.
If you do a fancy, if you apply for a permit.
Right? Yeah, even if they don't remodel, it is the market, right?
Well, and we have to think about time horizon, because if they're already 65 or older, chances are good for most families here anyway, within 15 years at the most, they're going to sell that home. And that home may be sold to somebody over 65, or may be sold to somebody who's 35. We don't have a way to know that. So what is interesting to me so far anyway, and again, we only have 4 years of data here, is that the number hasn't fluctuated a heck of a lot. So what is the number of homes valued above 500K have gone up for sure.
Quite a bit, yeah.
But the number under 500 has, I mean, it's not a straight line, but it's pretty darn close, as opposed to these others that are ramping up, which is also why when I shared the thing about the Word doc, that we have to there has to be a time slice. And if it's if we're talking about this being revamped in 2021, right? Mm-hmm. Then the best possible data we could have at that point would be second billing 2020, because again, all the challenges to the assessments have been settled out, and it's the most stable number that we can use. So if we were seeing these blue bars, if I saw those either going up or going down, that would be one of those other things you'd have to get your head around of, well, okay, do we have a stable subset at 500K or less? And it looks like we do. We have growth over here. And obviously this doesn't take into consideration at all the money that's brought back in, assuming that seniors sell, people who are currently taking the S4 sell to somebody who doesn't qualify for the S4.
Yeah.
And that is and there are enough sales that happen that, and I'm confident we could go back and get at least some of that data for sure, because it's as simple as, and I already have the data for 2013 through 2018. We just have to grab the rest for 19 and 20 to look at the ones that shifted from one exemption set to another. it's also pretty darn easy to look at the tax digest and to see that a sale has been made because the name in the first billing is not the same as the name in the second billing, and to see the whopper jump in value because people are selling for, in some cases, hundreds of thousands of dollars more than what their latest appraisal was. That's just the market. So I don't even know how to approximate that other than literally going back and looking at, and I wouldn't go all the way back to 13, maybe looking at 17 through 20 of the sales that have happened. It's a manual process. You have to look, well, I guess we could use a VLOOKUP exact match, but we'd have to look for the parcel ID number and to say, do the names match? And if they don't, okay, what exemptions were they taking before and now what do they qualify for? And that's quite a data project, but it would answer that question. So when we look at these numbers, we have to realize that we're not talking about any of that money being added back in. To me, I think of this like a tax exempt piece of land indicator suddenly being reinstated to the tax roll, kind of like the Callenwald property went from being tax exempt because it was DeKalb County to now certainly producing tax revenue for the city. What's the net upside to that? We're not looking at that in this case of somebody taking the S4 sales to somebody who doesn't qualify for the S4, and now you're getting the school taxes coming back in.
Well, wait, I mean, that is, if we pick the one spot going forward and hold it, you're saying? Yes.
Yeah. Yeah, I'm just saying that this in no way takes into consideration any of those sales of somebody's home that was taking the S4 that then after that sale does not qualify for the S4.
Wait, and these numbers in front of us, it doesn't do that?
No.
But I mean, wouldn't it, like the 989, so between the 1033 and the 989, there are, like, that number did decline. That loss declined because a certain number of those homes came back into the digest, basically.
Right. I'm just saying that yes, I'm only looking at S4 properties here. We are not looking at the entire digest, is my point.
Got it. Okay. Yep.
We would have to look at this as the entire digest to do about a 10-part calculation, to be honest with you, to figure out, okay, what were the exemptions on every property and what was the net year after year, and realistically look at it that way. Because again, Decatur's tax digest, we've got a 6.5% increase in 2019 to 2020. And I'm sure that will slip down a little bit because people will challenge assessments, and we know that's typically the case, but it won't change much, that's for sure. So every year that this goes up, my point is that sticking to just that 1.2 number as a net number, as a solid number in this calculation, as opposed to an actual net number, I can't get my head around that because the digest keeps going up. And you're right that some of this would be reflected because that, again, that's how we got from 1033 to 989, where properties were sold and then they no longer qualified. It's just a good deep dive into some complex numbers to try to figure out. And I'm sure there's tax modeling software out there in the world. I do not have access to that.
Let me bear with me as I kind of do just a quick thought experiment. But if we fix the S4 at a certain home value, and let's say we're going to pick 500,000, and we set it for all of the home values that are currently 500,000 and hold them there until a change happens, right?
Right.
We have built into the S4 a firm extinction of it, right? Because you don't get added back in.
Right.
There's not enough properties being built that are under $500,000 being sold to seniors. Right. So the pace at which seniors, 65 and up, that's, 15 years basically from that point forward expectancy before there's an event. Nothing is being added into that number. and
No.
only elements are being subtracted out of that number. Basically, we're putting maximum a 15-year lifespan on the S4, but likely substantially less than that as the properties continue to grow. I mean, there's a threshold number under which there aren't any homes less than that value indicator.
Correct.
And that's going to hit $500,000 at some point, if that's the number that we pick, right?
That was actually why these calculations were so important, to look at the average and the mean and the median of the properties that are currently in the S4. And yes, you will have people who age into the S4. You've got people who are 64 today that in another year will be 65. If their property is valued at less than 500,000, then they get added into that number. So there's a constant pipeline coming in, assuming that we haven't driven all the less than 65-year-olds out of here, which I hope we have not done. So there will be additions to it as people age into the possibility of qualifying for the exemption.
But it's not, I think my point is that it's not a normal decay on that 1.2. It's going to follow a different, it's going to decay much more rapidly after a certain point. That is
quite likely, yes.
I mean, and when I say decay, I mean that 1.2 is going to drop,
yes,
benefit to the schools, but not necessarily supporting the objectives we're trying to do here, keeping it at 1.2.
Well, and that's why with the increase in the property digest into 2020, we go from 128 to 122. I would anticipate that we could project that out several years, yes. And it's just going to keep dipping down, down, down. Or it may plateau. We don't really know. I mean, I don't have that crystal ball. What I have is 15 years of property digest data to look at a steady climb with a couple of plateaus.
I will say that the intention, and anyone who just kind of like reading the goal is a 5-year revisit on this. I think any responsible bill writer for a tax exemption, because we are talking about pegging it to home values, that was part of the conversation, is that we don't want anything 10 years would be irresponsible more than 5 because of everything that you've said, right? Like it could go up, it could go down, it can, who knows what's going to happen. And so even though it does require a lot of work and a lot of revisiting, it's worth it. So
I mean, I think we're saying with a fairly high level of certainty, if we peg it to a particular home value, it is going to go down.
Yeah.
Yeah. And so that makes it worth revisiting in 5 years and, maybe sooner than that, depending on how fast it goes down.
Yeah. And I think that's a pro and a con to an income approach as well. It's like,
well, income adapts slower than home values, right? And
okay.
So if we do have an income element of it, I think that it stabilizes the decline. Frankly, actually, then you do have more of a fluid situation where it could go up or it could go down. If it's hard pegged to home value, I think it firmly goes down. If you have an income element, I'm not trying to overcomplicate it, but I mean, just as we think through it, if we are going to take this particular approach, I can see a scenario where it's not 1.2 in 5 years. It's more like 700,000 in 5 years. And so maybe there should be some boundaries or some thresholds where there's a revisit more quickly than 5 years if it declines more quickly than we anticipate.
I think one way to address that, though, could be to build in a CPI, like in an inflationary growth factor.
Yep. So like if that home value could float higher, right?
Yeah, and new ones too. So that say in 5 years, your threshold wasn't $500,000, but it was $530,000 or something. Yes. So that you're building in more room for new seniors who move in or who age in to be underneath that threshold level.
Yes.
You know, that's one way you could do it without having the 1.2 decrease by tying it to a hard number.
Oh, that's cool.
All right. Well, thank you for your questions and input. I'm greatly appreciative. I think we definitely need to get this cross-subsidy question answered so that either this gets scrapped or we say cross-subsidizing is actually allowed, and we're looking for a net here among the S4s.
I just want to say, I don't know that cross-subsidy is, and I don't mean to be picking apart semantics, but I don't think that that's necessarily, I think it's fine for people in certain homes to be subsidizing people in other homes with respect to property taxes. I mean, truthfully, that's what those of us who are not seniors now are doing with respect to, you know, the senior exemption. I mean, we are effectively subsidizing because the seniors are not paying in. So I don't think that, you know, subsidization is necessarily a bad thing. It's just the question is whether the 1.2 is supposed to come off the top, or whether you want to make it so that when you remove the exemption, whatever you replace it with is only $1.2 million less than, so, you know, whether that net difference between what you add in and what you keep out is only $1.2 million. And I think that's more the question. I think, because too, when you talk about subsidizing, well, yeah, you can definitely have one group of taxpayers subsidize another group of taxpayers. I mean, that's what our tax system does.
It effectively, are we supposed to be the easy approach, which means turn the S4 into a 1.2, or do we have to account for all of the folks that come out of the S4 and then immediately turn around and take other exemptions and make that also 1.2, right? I mean, that's that. I
think we're just looking at the S4, right?
Yeah,
and how we're going to replace the S4 with an S4
plus,
you know, Model 2, you know, that has less of a revenue impact.
I think that the other piece for me on this one is that if we take, and I'm looking at L7 now, if we say that the 3.3 million needs to be 1.2, it is dramatically changing what people have been experiencing for the past, what, almost 4 years now.
But that, I mean, that comports, right? We're going from a $5 million net exemption to a 1.2, right? So basically, you know, 75% of the people getting it right now are going to be torqued. That's the outcome. I mean, that's what's going to happen.
I am so grateful I did not spit that on my keyboard. Oh, that was close.
So, and I want to mention here, and I don't know that it's been mentioned so far. I don't know if Meg's still on because I can't see everybody, but you know, the Decatur's representatives introduced, and it was a message bill. It was clearly a message bill based on the timing of it, but they introduced legislation to, hey Meg, to basically extend the homestead exemption for another 10 years and reduce the age to 62. And again, I am certain based on the timing of it that it was a message bill because it wasn't introduced in time to actually pass, and it didn't pass. But the point of me saying this is just to say that, you know, we can come up with something and CSD can come up with something and propose something, but the delegation can do it at once and pass something completely different and put it out to a vote. So we may want to consider a couple of different scenarios, and one that actually does meet the goal of getting to the 1.2, but one that does something more like this, like what Paula has come up with, that isn't as favorable to the school district, but in a pinch, we could pull it out of our back pocket and say, okay, well, if you don't like that proposal, here's something else that, you know, we don't like, but it's less bad. So just something to think about, or James, for really more for you to think about than for this group to think about, is having a backup plan just in case. Part of me thinks that it wouldn't, what the legislators proposed wouldn't pass because they wouldn't be supported. It wouldn't be supported by the community enough to pass. But you never know when people get to the polling place how they're actually going to vote.
Right.
So, I mean, I think if I, like a quick summary, please everyone jump in if I'm missing things. But I think first there's that outstanding question around basically, is it the absolute of the S4 that needs to be 1.2, or is it the net that we're describing? I think, I mean, I pretty firmly think we're all in agreement that we just need to go ahead and do the data and run the analysis. The tablet tool isn't going to be flexible or capable enough to do what we need to do with it. And we're on top of that, I think, at least I'm happy to go on the record and say I'm uncomfortable that they can't provide an N. That tells me some fairly substantial either flaws or error bounds in the raw data that concerns me. You know, at what point do we pay Paula for doing all of this modeling? We're basically asking you to become a data scientist, Paula. But I think there's an exploration of what house or home value gets us to the number that we want to see. And then from that number, projecting it forward, we can talk about what that inflation rate, index rate we want to put on it to hold us at 1.2 going forward. I think that's a piece of work, which I'm happy to help with, by the way, Paula. I don't feel like it's fair to ask you to do all of this work on your own. I think what would be helpful to see is the current value of that S4 exemption based on the current assumptions versus what the value of the S4 exemption would be next to it if we change the assumptions. Do you see what I'm saying?
Yeah.
I can't see the spreadsheet now that you've taken
Oh,
it down.
I'm sorry.
But no, you don't pop it up. But I mean, it's the because if I was looking at those numbers correctly, the under 500 and the over 500, if I added the black number, which what we're putting back in, if we're assuming that's out, and so is the under 500 that's out, that was like a $5.5 million number, which is bigger than what I had thought the S4 was. Now, I mean, I could be wrong. We actually, that's also, James, probably something we definitely need. Like, so what, yeah, looking at that, wouldn't the current state S4 be the sum of those two numbers?
Yes.
So
yes.
it would be $5.6 something million dollars?
Yes.
Okay, so let's just be clear. We are being asked to take 5.6 and turn it into 1.2 is what we suspect the actual, the request is, right?
Correct.
So we're doing a 20%, we're 80% reduction in effect.
Correct,
And
yeah.
I do think based on the 2017 numbers, because I remember doing the math back then, and I'm sorry, my dogs are barking if you can hear them, but
Sorry.
I remember doing the math in 2017 and when it was estimated to be a $1.6 million cost and wondering, okay, where is this other $2.7 million that is not there now that used to be there? So I do think actually the 2017 numbers, when you add the red and black, is probably about right for what it looked like then. But the other thing I wanted to say is James, I do think it would be helpful if you guys would talk to the legislative delegation and let them know about this $1.2 million number, the reduction, you know, because it is significant, and let them know that that's what you're looking at and why, and kind of keep their perspective on it. Because if they say, no, there's absolutely no way we're going to do that, find a way to cut it in half, or if they have different parameters they want us to consider, it would be helpful to know that sooner than later so that we can come up with something that they are amenable to if it's not this.
Okay.
They're going to do something during the 2021 session. They have to. So it'd be great to know what they would be comfortable letting us live with.
But I do think, I mean, kudos to Paula. I think this approach by using home value simplifies fairly dramatically the way we think about it, and yet it's still, you know, at 93% comported to the individuals that actually need it, right? And so that's I'm pretty highly encouraged by that. I was all ready to crap all over a home value approach, and yet it looks really good. I think that's actually a pretty reasonable way of looking at it. So thanks for this. This is a super helpful analysis.
You're welcome.
Chime in and thanks to Paula for building this and walking us through it. And, you know, I will totally concede that I left my days of doing anything related to qualitative analysis back in my undergrad days, which was a long time ago now. I want to say something else about what Gwen just raised. I mean, I think that I was a little surprised. Gwen forwarded the draft legislation to me, and I agree with her that they were trying to send a message. And, you know, I texted my personal representative and senator for the part of Decatur I live in. And I know, James, this will be words you've heard coming out of my mouth before. I think that the failure to build a relationship with the entire delegation that represents the city of Decatur will continue to pay out negative dividends if we aren't completely deliberate about the way that we incorporate them into a planning and design process. I think Gwen and I exchanged some notes, and I think that I agree with her that it was a message bill. I think that it's a question of what message they were trying to send, but I don't think you can construe it as being one that they're pleased with City of Decatur schools. So there's work to do there. And I think you've got an opportunity to really show the level of work that's been produced by this committee. I do think, and I was going back through the meeting materials that were prepared for today and thinking about it, I also think that the quantitative often can't stand alone. And I understand that as a sort of, if you look at the FAQ and the things that have been produced, we've named that we're trying to keep, we want to help seniors age in place. I think, and that there was a previous desire to, you know, to sort of curb enrollment, and that's kind of gone out the window. I think especially because we have data that says it's not really working, it's really important for us to articulate a set of values around this, especially if we're going to take an approach that's related to home value instead of to individual people. And I think it's especially driven home by that map you showed, Paula, of like where the houses are, where it's clustered. We have race equity as a priority for the school district and for our community. I think we're missing an opportunity if we don't tell that story alongside the approach that we're developing for how to think about it. And doing that now may also help with any revision that needs to happen. If it's just, we make clear what our intent is in trying to do this. I'm increasingly convinced that this alone will continue to not solve the problem, though I have absolutely no issue or qualms with trying to give relief to folks if there's a possibility that would help solve the problem. But just more, again, I am coming at this from a purely qualitative, not quantitative analysis point of view. But to me, the pieces of the story is what's missing. And if we can tell that story in a compelling way, it helps, I think, also inform for our legislative delegation what it is we think we want to do in our community. So
sure. I guess I'm not the beginning charge, and the larger conversation is about that when we get to this conversation, the intersection of housing and access in this city is steeped in some really screwed up racial politics about who could afford a house in the 80s, in the 70s, et cetera, and being able to afford it and stay into it. And the opening call or charge that you all have in this document that was written, we spent hours on, and I encourage you all to read it, where, you know, all of the members of the board and the, you know, equity director sat there and went back and forth with the language, because who can afford to live a house, who owns a house in Atlanta is not a neutral act by any
set of the imagination. Danny Sanavasi, who was on the board with you, Paula, literally works on redlining in Atlanta, and presented some data to me that he forwarded from the Fed about just the history of who has bought houses in Decatur, et cetera. And so I'm with that. I do own a, I mean, I've heard it from you, Meg. I had a meeting with my representative as well on March 16th. I went to her office on March the 12th to explain to her the committee and what we were meeting with and what the goal was, and she was a no-show. And then we had a phone call on the Friday, sorry, pulling my calendar up, on March the 13th to explain to her the charge of the committee and what we were working on and that sort of stuff. The conversation lasted about 45 minutes, and I typed it up and followed through on that. And then the world fell apart, and I kind of stopped following through. And so that does definitely fall on me, because then the next thing I knew, I heard it from you all. But the sentence you said is absolutely right. We need to follow through on planning and design and the process with that delegation very clearly. Sorry, that's two things.
Well, I mean, the information is all here for that, right?
Yeah.
I mean, even if just speaking from a quant background, the correlation between those who need it and the home value that Paula put forward, that's going to be a very high correlation. And
yeah,
we can frame that in terminology that doesn't use the word correlation. But the fact is, it looks like this approach actually does identify to a very high degree the individuals that need the exemption in a way that allows us the flexibility to move it within the parameters that either the school district or the delegation will permit us to. And so if we go with an aggressive one, and I mean, I do think an 80% reduction is going to raise eyebrows. We've already talked about that.
Yeah.
This allows us a way to back off that 80% with a very simple metric that still actually highly correlates to the individuals in need.
Yeah. Yeah, I thought the map was great.
Another thing to think about too, though, is whether the legislators and the public are going to be okay with giving some seniors zero exemption, given the bond referendum a few years ago and kind of the tacit understanding that there was a relationship between the homestead exemption and the bond referendum. I think Dr. Judy indicated, he indicated to me, and then I sent it to you all, but I don't remember the exact number, but it was roughly $400, I guess, was the amount that somebody pays and bond on the bond referendum per year in like a $500,000 house. So we may want to consider as part of this, you know, a $400 property tax break or $500 property tax break for all seniors, or something to that effect, just to keep that part of the bargain, which probably shouldn't have been a bargain, but it was kind of understood that way.
Actually, Gwen, it's a really good, I don't know if this mechanism is permissible, but the bond referendum has a fixed millage, right? I mean, there's a number that is attached to the paying off of that. And I don't know if we can assign an exemption to a millage rate, but yeah, like I think that that's a very reasonable approach to offset that concern, that we will actually back the referendum, not the referendum, we'll back the bond out of your taxes. And that's not an arbitrary number that you have to set. I mean, that's a fixed number that's very, I'm saying.
Yeah, I don't know if you can, well, actually, I mean, the millage rate, I think, has to be uniform across all properties. So but there's probably some way that you could finagle it from a mathematical standpoint and come up with some kind of an approximation. I don't know, but I do wonder, you know, thinking about the legislators and thinking about the public, and is there going to be some kind of expectation of, well, I'm paying this on the bond, shouldn't I get some kind of break? Because that was part of the conversation.
Which of course just makes it an even more interesting challenge to try to come up to that 1.2 million loss, right?
Well, and we may actually need to have the district justify the 1.2 million number too, because, in 2016, when the homestead exemption passed, the expectation was based on nothing, no math was done, but the expectation was it was going to cost 1.2 million. Well, you would expect though, or I would expect anyway, that cost would increase every year because the property values increase every year. So I would expect even if it had actually only been 1.2 million in 2017, that it would be more than 1.2 million by 2022.
Mm-hmm.
So I'm wondering if there might be some room there, or if the district can look at it and say, well, yeah, if we got rid of this exemption, we would be getting $47 million from property taxes. We can afford to go without 2 million of it. Or, if they could actually show the math of what they could withstand in a revenue loss from a homestead exemption. And that is really tricky right now because we're expecting, I can tell you from the municipal side, that we're expecting property tax revenue decreases over, if not this year, then next year. So, I mean, you're looking at, property values from a real estate standpoint, things might not go down, but people paying their property taxes, you might have some
collections will drop.
Defaults there, yeah. So, and property tax lags the rest of the economy when it comes to going down and when it comes to coming back up. So, that's something that the district's going to have to consider is how much can it afford. But if it thought it could afford 1.2 in 2016, 2017, then I would assume it could afford more than that now. I don't know. I mean, James, that's kind of a you thing, but.
I mean, mathematically speaking, taking all the emotion out of it, when you said 1.2 in 2017, you said what you were comfortable with in 2020. I mean, that math is a very straightforward calculation. And I mean, it'll be 2.8 million right now. Not saying that has to change the 1.2, but that if I was on the delegation, I would not miss at all what Gwen is saying right now, and I'd be challenging you on it.
Yeah, I mean, and you could probably figure it out if you actually looked at the digest growth off of reassessments, even from 2016 to now. You could figure out that percentage growth and apply it to the 1.2 million and get to some number.
Yep, exactly. The other thing, just to be clear about the math, is that if the number is a solid 1.2 now, then what you meant in 2017 was more like 650,000, right? So it's not like there's a ton of wiggle room in there. It's one or the other.
Okay, we're coming up to an hour and a half. I have lots of good notes. I think within them, there are a lot of to-dos. A lot of calls, some questions to be answered. If I type these up, we can sort of respond to them. I mean, there's obviously some people missing. I got a few emails during this with next steps and things you all want answered. How do we feel about that? Paula?
I feel fine about that. I would like to offer one last little nugget of information related to, again, I'm not trying to beat a dead horse, but here she comes again. I had a real estate friend pull all the sales from 2013 through 2018 that went through FMLS, which is pretty much anything that sells in Decatur, that's where it's listed. And the number of sales that were in the GSU data set compared to, and I use the entire year 2018, not just 9 months, is a delta of 600. They have 600 more sales in that data set than we found in FMLS. And that's about 20%, a little north of 20% actually. And to me, it's one more reason why I just can't get my arms around the integrity of that data. It's unfortunate. I can't fix it. I am not going to do the work that's required to match all those up and say, okay, well, and anyway,
It's almost certainly a model data set, which means there is going to be a large, I mean, we're just not talking about a large enough number for a model data set to have very tight error bounds. And so they're going to have large error bounds. And that 20% does not shock me at all when you're talking about a relatively low end model data set.
Well, for me, for them to say that they're looking at 3,600 and some odd, 91, I think, and the number was actually the home sales that we could see that through FMLS, that would mean an average of about 100 homes every year in that 6-year period being done off book. And the real estate folks that I talked to just scratched their head and said, it might be 5, it might be 10 in a year. So if that was I'm sorry, my old database administrator days, if that data is that different, I can't have faith in anything that I'm trying to use with it. So I'm going to never mention the GSU study again. You have me on record. I promise. I'm done. I do feel good that we can use current data and even try to project forward. We could do some flatline models and some small growth and then some large growth. You know, plot the actual growth we've seen, and then flatline that and do some calculations. Maybe do a 1 to 2%. You know, and then do what we've been doing, which is typically 5% year over year. We could look at where all that bounces out, but we still have to have an answer to that question. Are we talking about a net number, or are we talking about there's no more? And I just don't see how in the world you can pull this off if it's just supposed to be a 1.2 million loss, not a net loss. I can't get my head around that one. And I've been doing this since last summer, so it's not going to be meaningful enough I think it's too drastic a cut that we're going to see a backlash, and I think we would like to avoid that.
Agreed. Okay.
Paula, would you, do you mind sending me that spreadsheet? Because I'd be happy to toy around with it as well.
Sure.
Shannon would like me to remind you all to try to use the group email thread so that we're all on the same page for some of this data stuff, just because that'll make sure people show up for meetings and that sort of stuff. I will type up these minutes. Shane and I will go over them. It'll include some questions, make sure that are being asked and answered, some to-dos moving forward, and a meeting for late July. Shane.
Are you all happy with the way the web page is looking, or is there something you'd like to add to that tab when people go to the site? I mean, I have documents and the frequently asked questions and other information out there. If there's anything else you would like for me to add, please send it to me and I'll get it out there. And again, please use the email address that was set up for the committee. That way we're all on the same page. And I believe everyone, you have my email address. Contact me if you need anything. And I'm available if you have any questions. And I'll also, any of the information that came up with needing Dr. Duty's answers from Dr. Duty, I'll make sure he gets that as well.
I would like to make sure that the next time we gather that we talk about community engagement and how we're going to, how we see ourselves doing that. Go ahead, sorry.
Another thing, we really need to get an agenda. So if when we're doing the meetings, so if anyone, I can send out an email on behalf of Paula and James asking for what we would like to have on the agenda so that we have an agenda that we're sticking to. And monthly when you all are meeting, if you'd like for me to do that, just let me know.
Okay, thank you. And for clarification, am I just sending this spreadsheet to Han so he can have some fun with it? Or does everybody want to see the spreadsheet?
Or do I have a job to come out of it? Yeah.
Well, you might, because the next thing I want to do is connect you with, and actually we've already done this through the group email with Chris Grimes, who is the master holder of all these data sets. he has been an absolute champion. Anything I have asked him, he shows back up with. And
Fantastic.
he is grooving on this. He's a data nerd. He's certified. And he's like, ask me anything, I'll try to get to the bottom of it for you. So I owe him big happy thank yous. And I'm confident that he would be more than happy to be part of trying to crack this nut. But I don't think there's any more nuts to crack until we know the answer of, is it strictly no more of a loss of 1.2, or is it a net?
Yeah.
So.
Okay.
What I was hoping to do was to take it and put a couple of the little things into it where you could change by like home value or things like, so regardless of what the answer to that question was, we could, like in real time, see what that impact would be. But
So
I mean, I 100% agree with you, Paula. If the number is 1.2, we're talking about a home values of, 250,000, right? Like it's going to be a very small number.
Yeah, that is a very small number.
Or just less of an exemption.
Yeah, right. So 50% instead of 100 or whatever it may be.
So what needs to happen for that then, Hans, is you actually need the digest, not, this is a roll up. You need the actual digest. So if you cannot find Chris's email address, please send me one and I will gleefully connect the two of you. Because I have a 2019 second billing that has, and I can send that to you. That's not a problem. And that's the raw data that you can play with.
Yeah, I'll probably want to toy around with all of them, so I'll reach out.
Okay. Fair enough. I'm done toying for now. I've given you guys an approach that I thought through and tried to make sense. But until we have the answer to that other big question, I'm not touching it anymore. Not yet.
All right. I've got to go.
Thank you all.
Thanks, everybody. Good to see you all.
Thank you.
Thank you all for coming. Thank you for your time.
Bye-bye.
Bye-bye.